The S&P 500 is essentially flat for the year. Earnings from first quarter through the third quarter are basically flat, continuing on through the fourth quarter based on revisions, and revenues are actually down 4%. So it's an interesting place to be. You have stock market multiples are slightly elevated, but that's because we all know rates are very low and probably not going to be high anytime soon, and this is kind of where we're stuck. Is anyone here surprised that we're flat on the year, haven't made much progress because earnings have not? Is that a shock to anyone here? And do we think that this is probably the way things continue for a while? Jim, if you want to start.
Well, it's even worse than you said, Josh, because earnings not only are down, but actual GAAP earnings, and I know that's an antiquated notion,
Right.
GAAP earnings are back below $100 for the S&P. And importantly, the dispersion is even not as great as you think. Ex-oil earnings are up slightly,
Right.
and without buybacks, they'd be down per share.
Right.
And that's the other key thing. We've had financial engineering keeping earnings per share up for a while. So,
Right.
Savita,
But I would say the other thing is that we have all the companies talking about how they're making earnings in the rest of the world, but when they bring them back into dollars, they're down. So part of it is the drop in oil, part of it is the stronger dollar. You take those two things out, we don't have strong earnings growth, but we actually do have some earnings growth. And I think that's actually really important as well. Part of it's financial engineering, but part of it's also these two negative factors.
Right. Do you have a view on that?
Well, I think what we're seeing, I've obviously focused more on technology, and I think
Right.
what we're still seeing relatively strong growth, the underlying
One
investment.
of the few
One of
parts
the few
of the
areas, and I think,
economy.
obviously tech gets a lot of focus because of high, sometimes actual, but often perceived multiples. But if you look across almost every sector of GDP, nothing has had the growth that sector has had over the last 5 or 6 years. I think if you look at more broadly, when we just look at the market more broadly, I think the other thing that we see is that non-tech revenue growth has been challenged, and a lot of earnings growth has come from expenses and expense reductions. That story you can only do for so long.
yeah, like about 20 years.
Right. And so I think that we are not seeing any slowdown in fundamental tech spending.
Right.
I think we're seeing some of the macro headwinds because increasingly, currency headwinds, I should say, which is that a large portion of our companies now are generating a significant amount of revenue internationally. And
Kate,
so,
you've said that multiples have pretty much done a lot of the heavy lifting, and without earnings growth, it's really tough to make the case for the bulls from where we are right now. Where, and this is for everyone, where will that earnings growth come from? Obviously technology, but even that seems an increasingly smaller group of technology companies benefiting greatly without a lot of participation. So if not tech, is it healthcare, is it retail? Where will we see earnings growth come from?
Well, I think it's partly that we don't expect to see such a large drop in oil prices over the next year, nor do we expect such a strong rise in the dollar. So if you just get those two negative influences flattening out, then the rest of earnings growth, which yes is partly due to financial engineering, but is also due to continued cost cutting and to some of the mergers we're seeing where companies are saying, hey, the way to get more earnings growth is to combine the companies because we're not seeing the revenue growth.
Right.
I think we see single-digit earnings growth next year if those two factors hold. So it's not so much across the sectors, it's more if you just get rid of the negatives and
whole
they're
S&P
flat,
500.
exactly, then what you get is single-digit earnings growth.
Savita, what's the view from Bank of America Merrill Lynch on earnings growth, multiple growth, et cetera?
Sure. So, I think that next year could be a better year than this year for those two reasons. Really we're lapping the dollar. So if the dollar rises, we're forecasting about a half as much dollar strength next year as what we saw this year. That's less of a drag on S&P earnings. If oil prices stabilize, which is an open question, that could be, again, a removal of this massive headwind this year that we saw, oil prices cut in half. So those are two hopes that we see driving earnings growth next year. We're not really looking for a massive acceleration in the economy.
Right.
So that is where I think tech and sectors with secular growth really shine. And what we've seen over this bull market is that it's been led by secular growth companies rather than cyclicals. Cyclicals have taken it on the chin because the cycle has never re-accelerated, it's actually decelerated. So that's one area of weakness that we think could continue.